Hedge options are a type of financial instrument that can help investors reduce their exposure to risk in the event of adverse price movements in the market. In this video, we will explain what hedge options are, how they work, and why they are useful for investors. Hedge options are contracts that give the buyer or seller the right, but not the obligation, to buy or sell an underlying asset at a specified price within a predetermined time frame. The underlying asset can be a stock, a commodity, a currency, an index, or an interest rate. The specified price is called the strike price, and the predetermined time frame is called the expiration date. There are two types of hedge options: call options and put options. A call option gives the buyer the right to buy the underlying asset at the strike price before or on the expiration date. A put option gives the buyer the right to sell the underlying asset at the strike price before or on the expiration date. The premium is the fee that the seller of the option receives from the buyer for entering into the options contract. It is determined by various factors such as supply and demand, volatility, time to expiration, and interest rates. Hedge options work by allowing investors to take offsetting positions in derivatives that correspond to their existing positions in other assets. For example, if an investor owns 100 shares of a stock that is trading at $1.50, they can buy a put option that allows them to sell the stock at $1.45 anytime within the next month. This way, if the stock price drops below $1.45, they can exercise their put option and limit their loss to $5 per share. Alternatively, if an investor expects a stock price to rise, they can buy a call option that allows them to buy the stock at $1.55 anytime within the next month. This way, if the stock price rises above $1.55, they can exercise their call option and profit from the difference. Hedge options are useful because they provide investors with flexibility and protection in uncertain market conditions. By using hedge options, investors can reduce their downside risk without sacrificing much upside potential, lock in profits or losses without selling their underlying assets, adjust their exposure to different factors such as volatility, time decay, and interest rates, speculate on future movements of prices or volatility without owning or shorting the underlying assets, create complex strategies that combine multiple options with different strikes, expirations, and types. However, hedge options also have some drawbacks that investors should be aware of. They involve transaction costs, such as commissions, fees, and bid-ask spreads. They require constant monitoring and adjustment as market conditions change. They may expire worthless if they are out of the money when the strike price is unfavorably compared to the market price at expiration. They may expose investors to unlimited losses if they are short, sell, naked, uncovered options without sufficient collateral. In summary, hedge options are a type of financial instrument that can help investors reduce their exposure to risk in uncertain market conditions. Investors who want to use hedge options should learn how they work and what factors affect their pricing before entering into any contracts.